Let's talk about why the AMC short squeeze is essentially over. It's not going to come back. It's done. It's been done for a long time. However, I think people are now having to come to the reality. However, we understand that there's going to be people that are never going to come to the reality of what's actually going on with this particular play. We're looking at AMC stock on the yearly level, right? And what do we see? We see where it's currently trading at now is around $6. Close a little bit under that in the aftermarket. And where we're at is we're almost where we were at before the whole scenario or this whole storyline started. So what we've done is we've traded up, and like what most stocks will do is we retraced back down to our normal trading pattern. And this is why understanding what a historical trading pattern is so important, because unless something fundamentally changes around either the market or the company, under normal circumstances, the company or the stock will eventually go back to its normal trading pattern. If we zoom out, what do we see? It traded at these prices for a very long time. It traded at between 10 and 20 for a very long time. And then it started to move up. So where we at right now, we're back under $10. That's where we're currently at today. Back under $10. Big move up early to mid 2021. Massive move up with a massive demand. And then what did it do once it hit $60? It just kept selling down. Now, you can come up with any rationale for why it's sold down, but we know the price action is telling us that it sold down and it didn't go back up. And nobody wanted to buy it at $70, $80, $100. They wanted somebody else to get it to that price for them, but they didn't desire to buy it at that price. Looking at the APE shares, which is essentially a way for AMC to create more liquidity, ever since that came out, it's sold off. It's trading now at what? $1.07, right? Moved up a little bit in the aftermarket, up 1%. Right, this eventually will go to zero. And it'll go to zero before AMC does. But yeah, this is going to zero probably by the end of next year, if not earlier. This will be trading at under a zero. And if it stays under $1 for a certain amount of time, it'll get delisted. Okay. This is what the deal was with AMC. What did we talk about before? Massive debt, compressing revenues, and you can't take a technical play and turn it into a fundamental play just because you want to. Right? It doesn't work that way. Now, what we're looking at, how is AMC dealing with its debt? And this is going to explain to you how the market perceives this company and also the market for debt, especially the junk bond market at this particular time. And once you understand what a junk bond is and why a company goes to the junk bond market, it says a lot about that particular company. Because if Apple needs to raise money, they're not going to go to the junk bond market because the way they're viewed is going to be totally different than AMC. Here's an article from Seeking Alpha. AMC subsidiary, Audi and Finco, raises $400 million through a debt offering. So we get $400 million in senior secured notes due 2027 in a private offering. What AMC's doing is they have current debt. And they're doing what we call, like, you know, this from people that have credit cards or maybe even student loans. You're doing debt consolidation. I'm taking on debt today to pay off debt that's going to be due early. And I can take this debt and push it out a few years. The question is, what are the terms around doing that? Now, you see this in the credit card space where they tell you, hey, you can transfer your balance to this credit card. It'll be 0% interest. And then we won't charge you interest for like another 6 months to a year. That's designed to get you to get that credit card. Now, savvy people do that and they use that to pay off the bill at 0%. Unsavvy people, what they do is they transfer it over and then whatever balance they have left, they charge that up too. So then when the debt starts to trigger on when the interest rate starts to trigger, not only do they owe the old debt, but they owe the new debt. But credit card companies know that that works. That's why they roll that off route. But savvy people take that debt and they swing it over to that credit card at 0% and they pay their debt off now at 0% interest rate, as opposed to paying it off at their old interest rate. But the credit card companies know that most people aren't going to do that. So that's essentially what AMC is doing. What they're doing is that they're taking on new debt to try to push out current debt and push it out into the future, but pay off the current debt that I believe is going to be due in like 2023, which is next year. This is the challenge, though. They put this bond out, or they put this debt out at 14%, which is extremely high. But they're in the junk bond market, and they couldn't get a bite on that 14%. So what they ended up doing is having to get it at 15%. And they also paid, I want to say, 92 to 94% of it up front. So what they're doing is they took a lot of cash out of the company to pay for this particular bond. They're going to service it at 15% because what I believe is that the people that are buying this will say, well, you know what, we'll get paid at 15% for the next few years. And then what we'll do is we'll go to bankruptcy court and we'll fight for the rest of our money. Right? But don't be surprised in the next maybe 2 to 3 years, AMC goes into what we call a prepackaged bankruptcy. I don't see them having a lot of choices because the cash that's inside the company now, they need that cash to finance operations. They can't even use that cash to pay off the debt. So what they're having to do now is do an offer at a high yield to try to figure out how to deal with debt that is going to be due early, then push it off. But that doesn't change if revenues keep compressing, because how do you pay off the debt if you're driving less and less in revenue, unless you're going to pull the cash out of the company to pay the debt, but you need the cash for operations. And this is why, let's say the 1 month chart. You've seen AMC just sliding all the way down. And it's very unlikely it recovers. Let's go to the yearly. Look at this particular area. We get a gap down in August and we just slid all the way down. It's very unlikely this stock recovers because of the fundamental reasons, right? Now, what's going to happen? And this is what happens in any situation like this. The story's over, right? Now, you don't have to stop believing in stories, but you're going to have to stop believing in this story. And what's going to happen is the majority of the people around this are going to either just act like it never happened, which is what happens in a lot of cons. Most of the people that get conned, they never report it because they're embarrassed, right? It just happens. And that's why a lot of things keep going on in the world, because it never gets reported. The average person that gets conned is embarrassed they get conned. So they never report it. Second, other people are going to have to accept that this story is over and I have to find a new story. It's very similar to where you go to the movies and you could be watching a really good movie and you're caught up in that story. But you know what? The movie's going to end one day. So you get 2.5 hours of really, really good entertainment. The movie ends and now you got to go back to your regular life. However, this is why stories are so powerful, is because a person will buy into the story of something and they will distort their own reality to keep the story going. And that's what we saw with AMC. And the storytellers around this have moved on. They're not talking about this anymore. Why? Because they can't even keep the story going. As long as the share price keeps moving down and there's not even any volatility in the share price, it's just moving straight down. We can't keep the story going that this thing is going to move back up. Right? We can't. So what they're doing now is they don't want to be the last storyteller around AMC. Now, you're going to have some diehards. You're going to have some guys that are going to, this is how they get their attention on the internet. And as long as they can get people, get 1,000 views, 1,500 views around this AMC deal, this is the most attention they've ever gotten in their life. So they're going to just keep doing it. But the real big players around this story have all left. A lot of them turned into like inspirational stock traders now. They're doing like inspirational stories around stock trading. It's interesting because they don't have a company to hang their hat on anymore, right? However, what I want to really get you to understand is that when you don't actually understand how the market actually works and you just buy into what somebody's telling you around a company, you get caught into these type of deals. This was no different than these micro cap pharmaceutical pump and dump things. It just was played out on a larger scale, but it's the same type of play. Just got bigger than any of those micro cap pharmaceutical pump and dump stories that you hear in the penny stock space. And if you have a dissenting point of view based around the fundamental analysis of this AMC play, based around the fact that they carry a massive debt load, the revenues are starting to compress, right? And how that's going to impact the shares, because any other narrative, the shares that are in Brazil, the shares that the Transformers got, the Bilderberger Group and how they're holding shares, none of that is impacting price action. So it doesn't matter. What's impacting price action is how the market perceives the value of this stock, revenue compression, and the debt that this company has to pay back, to where they are willing to take on a 14% yield just to try to float this debt out into the future. The issue is they got to worry about what revenues are going to be used to pay the debt back. So like I said before, is that I'm looking for AMC to probably go into a prepackaged bankruptcy. The insiders, the CEOs, they've been allowed, they had like a miracle shot where they were sitting on a company with a massive amount of debt. Let's go back to the share price again. Let's go to the 2-year, right? They were sitting on a company with a massive amount of debt. You're losing your market because of streaming. You're trading at around $3 and $4. And then you get this grassroots movement, right, to buy this stock. And you're an owner of the stock because you're an insider. And now they drive this price up to $50 and $60, and you're able to exit at a premium, and you're able to keep these people on the hook while you and your insiders keep exiting over time. All of this time, the insiders are exiting. You're allowed to keep exiting, keep exiting. So this was a miracle for you, because initially you were holding a stock that was worth $2 and $3, and you're allowed now to exit at $40 and $50, and you own thousands, if not millions of shares. This is what these guys have been waiting for their whole life. Now they can transfer that wealth to their family, and the people that bought the stock are going to get left holding the bag. And that's why I really encourage you to actually learn how this thing works, as opposed to believing in something that's going to happen because somebody on YouTube told it to you. David W. Williams, also known as Diamond Dave. I'll talk to you later.